Okay, let's unpack this. We often think buying insurance is, a simple transaction. You pick a
Hmm.
policy, you pay for it, and you're done.
Right. But it's so much more complex, especially with accident and sickness coverage, A&S.
And the real work, the real architecture, it all starts after that initial fact find.
That's exactly where the deep dive begins. Once the agent has your goals, your resources, and those specific gaps, well, that's when the real craft of building a recommendation kicks in.
So we're moving past the data collection.
Way past it. We're focusing on those critical middle steps that decide what you actually end up with.
So our mission today is to break down these phases. The actual recommendation, the underwriting modifications, which happen a lot, and then the formal application process.
And the core of it all is the agent's ethical duty.
The duty of care.
Exactly. They have to design a solution that's genuinely suitable for your situation. And, just as importantly, present it so clearly that you can make a truly informed decision.
It's not about sales, it's about advice.
Understandable advice, that's the key.
So that suitability, it all starts with finding the gaps, right?
Yeah.
The agent compares what you'd need if you couldn't work against what you already have.
Right. Savings, a spouse's income, any existing policies, they're looking for the shortfalls.
And what's interesting here is that the first move isn't always to buy something new,
No, it's about optimizing what's already there. Before recommending a whole new product, a good agent should see if they can just modify an existing policy.
like adding a rider.
Exactly. Adding a rider, adjusting the terms. It's an efficiency check, really, to make sure you're not overspending.
And that brings us right to the biggest roadblock with A&S insurance.
The costs.
It's always the cost.
Yeah.
It's just a fact that these policies often have a pretty high premium compared to other insurance. Why is that?
It's purely actuarial. I mean, the things being covered,
Yeah.
disability, critical illness, they just have a much higher likelihood of happening than, say, your house burning down.
You can see it in the numbers.
Yeah. Oh, absolutely. It's clear in the insurer's claims ratios, and that risk, well, it translates directly into higher premiums. So when that number comes back way higher than you expected, the agent needs some levers to pull.
Okay, so let's talk about those levers. The first and, I guess, simplest one involves adjusting time.
Exactly. The simplest and often the most effective way to reduce a premium is by extending the waiting period.
Which is that block of time between when you get sick or hurt and when the benefits actually start paying out.
Precisely.
But wait, if we extend that period just to save money, aren't we just trading one problem for another?
That's the critical question. And it's managed through a very careful analysis of your emergency fund.
Your liquidity.
Right. If you initially chose a 60-day waiting period, the agent might say, okay, let's look at your savings. Can you actually float yourself for 90 days? Or 120.
And if you can't,
If you can prove you have the resources to survive that longer period, the premium can drop substantially. Because from the insurer's perspective, their exposure to all those small early claims just disappears. You're self-insuring for longer.
okay, that makes sense. And then the opposite concept applies to the benefit period, which is how long the payments last.
Correct. You can shorten it. So say on a long-term care plan, you could change it from lifetime coverage to maybe just 5 years. That also reduces the premium.
But that feels riskier.
It is riskier. The agent has a much higher duty of care there to make sure that shortened period still actually meets your potential needs. They have to document that you understand that trade-off.
Okay, so let's move to the second lever. The source material calls this one the more radical solution, just reducing the benefit amount itself.
It's radical because, in theory, that initial calculation should be your actual need. But this is where we get a real aha moment.
Because it challenges how we think about income replacement.
Totally. Traditionally, agents just use a percentage, right? Say 60% of your gross income. But if the premium for that is unaffordable, the smart move is to pivot.
And instead of income, you focus on,
Essential budget expenses.
this is a huge shift. You're going from insuring your lifestyle to just ensuring your survival.
And the example of Jason in the material just illustrates this so perfectly. He was making $50,000 a year. 60% of that suggested he needed, what, $2,500 a month in benefits.
But the premium for that was way too high.
Prohibitive.
Okay.
So his advisor had him create a crisis budget. They cut out all the discretionary stuff, restaurants, travel, the fancy gym.
The things
No.
you'd cut anyway if you were on long-term disability.
Of course. And his actual survival number dropped to $1,900 a month. That $600 difference in the benefit brought the premium down to a level he could actually afford. He walked away with protection he wouldn't have had otherwise.
That is so powerful. It really redefines what best value means.
And then there's the third lever, which is changing the nature of the contract itself.
Right.
The best policy is usually a non-cancelable contract.
Meaning the premium and the terms are locked in forever.
For life. But they're also the most expensive, so if that's out of reach,
What's the next best thing?
the agent might pivot to a guaranteed renewable contract. It's still considered excellent. The insurer can't cancel it, they can't change the terms, but they can raise the premium.
But not just on you, right?
Right, only by class. They'd have to raise it for everyone in your specific risk group. So it's a manageable risk that can make the coverage affordable.
So those are the tools for a standard risk. But what happens if you, the applicant, aren't standard? That brings us to the insurer side of the table, the underwriting decision.
Yep. This is when head office gets involved. Underwriting is basically risk management. It's how insurers stay in business and keep premiums affordable for most people.
So when you apply, they put you into one of three buckets.
That's right. Standard insurable risk, non-standard insurable risk, or the unfortunate uninsurable risk,
Right.
which is a decline.
So let's say they decide you're non-standard. Maybe you have a manageable health condition or a risky hobby. How do they modify the contract to take you on?
They have four main tools. The first is imposing exclusions. This is very black and white.
Meaning, we will cover you, but we will never ever pay for this one specific thing.
Correct. The second is imposing limitations. This is different. The risk is covered, but the benefit is restricted in some way.
So they might cap the payout amount or shorten the benefit period for that one condition?
Exactly. You get some coverage, but it's limited. The third tool is the one most people have heard of, rating the premium.
They just charge you more.
Well, yeah, but it's not a penalty. It's an actuarial adjustment. That extra premium, or rating, allows the insurer to build up a bigger reserve to offset the higher chance they'll have to pay out a claim for you.
It's the price of admission for higher risk. And the fourth tool,
Deductibles.
making you share the cost of a claim.
Right. It's very common in extended health and dental plans. It helps manage the volume of all those small dollar claims.
Let's use the Elvira example to make that concrete.
Okay. So Elvira's group health plan has a $200 annual deductible for dental. This means she pays the first $200 of dental bills each year out of her own pocket.
So if her first dentist visit is $300?
She pays the first $200, and the insurer then reimburses her for the remaining $100. It just cuts down on administrative costs for the insurer and gives Elvira a bit of skin in the game.
So we've designed the policy, we've navigated underwriting, now comes the moment of truth, presenting the quote. How does the agent deliver the news?
Well, there are two main schools of thought here. Option one is simplicity. The agent does all the homework and presents just one solution, their research best option.
Less overwhelming for the client.
Right. And option two is about empowerment. The agent presents two, maybe three, different but suitable options and lets the client be part of the final decision.
But that sounds like it could lead to analysis paralysis.
It absolutely can. If you give someone too many choices or the differences are too minor, they just freeze up and often end up doing nothing.
So if you're going to present options, you have to be really clear.
Super clear. You use a chart, something visual, and you focus only on the big similarities and differences.
For example, you might point out that both disability policies you're recommending are indexed to inflation. That's a key similarity.
Exactly. And then you have to highlight the critical differences. Like, with two critical illness policies, you'd have to say, look, this one's definition of a stroke is very strict, while this other one is much broader. Those are the details that really matter at claim time.
And no matter how many quotes you show, the absolute most important thing is
documentation. Always. It protects the client and it protects the agent. You have to record the specifics of the recommendation and, crucially, the rationale behind it.
the why.
The why. That rationale can literally save a career. Look at the Agent Horst example. He got a formal complaint from a client who said he hadn't done his homework.
But he had the receipts.
He had the receipts. He had kept his research grid comparing 5 different products. It proved his advice was diligent and sound. Case closed.
And beyond the product rationale, the agent also has to document and manage the client's own expectations.
Oh, absolutely. What benefit did they think they were getting? Did they assume they'd get a non-smoker rate? Did they think they were standard risk?
All of that needs to be on paper.
Mm-hmm. And if the final policy comes back from underwriting with, say, a rated premium, something the client didn't expect, the agent has to prepare a formal waiver for the client to sign.
And that waiver just explicitly says, I understand the policy is different from the quote and I accept it as is.
Exactly. No surprises, no misunderstandings down the road.
A good agent also knows that one policy rarely covers everything. Sometimes you need a couple of complementary policies for the same person.
The Elijah and Malik example shows this perfectly. The business needed a policy to protect itself if its key employee, Malik, got disabled.
So that policy was for a big amount, $10,000 a month, but with a long 6-month waiting period because the business had cash flow to wait it out.
Right. But Malik's family had a totally different need. They needed maybe $3,000 a month, but they needed it right away after a short 60-day waiting period because they didn't have that emergency fund.
Two completely different needs, two separate policies.
And the agent has to discuss both, even if the client only buys one. The documentation should note that a coverage gap still exists for the family. It's about making sure the client knows what risks they're still carrying.
So after all this back and forth, all the adjustments and documentation, we finally get to the formal application for insurance.
And this is the absolute cornerstone of the whole process. It contains all the critical health and financial information the insurer is going to rely on.
Everything else flows from what's on that form.
Everything, every background check, every medical test, it's all triggered by the application.
Which means the agent's role here is just absolutely critical. They're the expert guiding a layperson through a legal document.
And the key thing to remember is that you, the applicant, are legally considered a layperson. You are entitled to rely on the agent's expertise to understand those complex questions.
So if an agent messes up or doesn't ask a question properly,
The consequences can be severe. If the insurer discovers a misrepresentation on the application later on, they could potentially void the policy. That's how serious the agent's obligation is here.
okay, so if we pull back from all this detail, what are the big takeaways from this deep dive? It's clear that getting the right coverage is about so much more than just finding the cheapest price.
It's all about optimizing value. And the two most powerful levers for making that happen are, first, extending the waiting period, but only if you have the savings to back it up.
And the second one is that budgeting strategy we talked about.
Right. Moving from ensuring a theoretical income percentage to ensuring a real hard-nosed budget of your essential expenses, that can be a game changer.
And for the agents listening, the big takeaway is diligence. Document your rationale, use comparison charts, manage expectations with waivers.
It's all about protecting the client and proving you upheld your duty of care. The goal is always getting the most practical protection for every premium dollar spent.
We saw how that kind of radical budgeting, like in Jason's case, made essential coverage suddenly affordable. But that strategy hinged on his plan to cut discretionary spending during a crisis. And that raises a really important final thought for you to consider. If you're already planning for that kind of radical cost-cutting to design your insurance for a worst-case scenario, are you doing enough personal financial planning right now to handle the more predictable short-term crises? Like, can you actually survive the difference between a 60-day and a 90-day waiting period without that insurance policy?
Yeah.
Because that preparedness is what determines how much you really need to buy in the first place.